A soft landing seems within sight, and the market is looking for multiple rate cuts in 2024. But our guest today, Dana Dioria of Envestnet Solutions, still recommends caution. Welcome, Dana.
Hi, thank you for having me.
Let's talk specifically about small cap stocks. You had a call last year to start loading up on those. How are you feeling about them now?
Well, it was great to see in December the market breadth increase, and small caps finally caught a bid. I think with small caps, it's a longer term play, right? So there's reasons in the short run to think that they have opportunity, and that reason rests along things like, hey, this is more of a risk on environment. The Fed turned out to be much more dovish in their last comments. Let's see what happens. But in the last comments, and the market kind of just took that as fuel on the fire. And small caps, that had been kind of struggling versus the larger caps, the big tech, et cetera, Magnificent Seven, all of a sudden were, doing better. I think a big reason as well for that is if you think about what's going on with interest rates and what it means to self-fund versus need to go out to capital markets, right? So are you interest rate sensitive? Small cap stocks are, just more likely to need to access capital markets than somebody like the Magnificent Seven who self-fund on and on and on. So, certainly the prospect of lower interest rates is helpful in that respect. But on the other side, what I would say is, while I am a proponent of diversified small cap, it's really more of a long-term bet. So while short run, I think there's good reasons to think they do well, there's also what I mentioned before about caution. If the market is pricing in more rate cuts than are going to materialize, if the Fed doesn't turn out to be quite as dovish as maybe the market is hoping, then that can have, in the short run, a negative effect in the same way it had a positive effect on the other side. But that's not the reason you're holding them, right? You're holding them because over time they do tend to outperform, particularly if you excise these, very growthy, low profitability stocks. Small caps tend to do well, and lower price stocks with higher quality, where you also tend to see over time better performance, those types of strategies work well in small caps as well.
Do you think the market is getting too far ahead of itself with the rate cuts?
I think we've done a lot of pricing in perfection, which has become kind of a phrase, meme, whatever, out there. I think the market really took the Fed's comments, to heart and kind of ran with it. And obviously this year started off on a little bit of a different note, but that kind of noise, that kind of ebb and flow and pullback, I wouldn't read too much into. But I do think that the Fed will be worried about making sure that inflation really has been tamped down. The Fed's mandate is inflation and unemployment. So what you should expect is, if unemployment does start to tick higher, which shouldn't be a surprise, that will push the Fed to cut, which they're trying to open their way up to do. But historically, inflation does come in waves, so the Fed is going to want to guard against that as well. So I think they're going to be very data-driven, as they say that they are. But I think the expectation of a bunch of rate cuts starting, relatively soon might be a little bit rosy.
Another area I know you're interested in is ESG. What are you thinking along those lines, and how should investors be thinking along those lines this year?
So ESG, I think so much has gone into just the term, and I almost think we should just do away with the term. In fact, there are a bunch of people now, I think, calling for that just because it's gotten so politicized. But ESG at its core, I like to draw a distinction to a certain extent between sustainable investing and ESG investing. ESG investing certainly is an aspect of sustainable, but ESG investing at its core wasn't really about this values-driven, I want to save the world, as it was about how am I going to make money on the fact that the world is transitioning this way. So if you break up E, S, and G, environmental, social, governance has always had attachment to quality. And academic literature tells us that quality stocks, higher profitability stocks, tend to outperform over time. So governance always had kind of this attachment to an actual alpha thesis, or even a factor beta thesis, right? Because it's got that long dated history. If you think about what E and S were trying to do, it's really kind of an extension of that, right? It's saying, okay, if I have a company that has good governance and I expect outperformance in that company because of that, right? Do I also think that a company that pays attention to its clients or its networks, its supply chains, that it treats people with respect? Do I think that a company that's minding its impact on the environment, that's not sitting with a bunch of stranded assets and not preparing for a net zero type of a future, do I think those concepts will also outperform over time? And so ESG was really meant to kind of put together governance type thinking and identifying companies that will do better with a regulatory framework, with a client and partner framework that expects this type of behavior. And so, you can argue yes or no, you think that will happen, and when do you think it will happen? I personally don't think we have enough data yet. You see a lot of studies that say, oh, look, these types of companies outperformed, or no, they did terrible this year. The data is not in yet to make a judgment on this, but whether you agree with the alpha thesis or not, you know that there will be active managers who, the more this type of data is available, will figure out how to make good use of it like they do in any other type of active strategy.
Thank you so much. We appreciate your time.
Happy to be here.
For more, check out QZ.com.